Welcome back. When we left off last time, I mentioned that there is a downside to offering to let customers pay using credit. Unfortunately, companies need to deal with the fact that some credit customers go bad. In other words, they don't pay their accounts receivable. This is not surprising. When a company makes sales on credit, they expect that some of those sales will never be collected. Those amounts are referred to as uncollectible accounts or just bad debts. Now, there are two basic methods to account for bad debts, the direct write-off method and the allowance method. Remember that GAAP requires companies to match expenses with the related sales in the same period. The direct write-off method does not adhere to the matching principle. Instead, it permits companies to write off bad debts when it becomes clear that the customer isn't going to pay their receivable balance. That is often well after the period in which the sale has been recorded. Now, this might be okay when bad debts are expected to be very small. However, the majority of companies use the allowance method because it complies with the matching principle. Companies estimate how much of their credit sales will not be collected and record the estimated bad debts in the period of sale. As a result, under the allowance method, net accounts receivable is valued at the amount a company really expects to receive in cash. We call this the net realizable value. Now, we will focus only on the allowance method for the remainder of our discussion, as it is the most widely used and compliant approach. In contrast to the direct write-off method, the allowance method does attempt to match bad debts from uncollectible accounts receivable against the sales they help produce. We must use estimated losses because when sales occur, management doesn't know which customers will not pay their bills. This method requires that an estimate of bad debts be made and recorded at the end of each period. To repeat, under the allowance method, we have to estimate losses because we don't know exactly which accounts will be uncollected. Because we can't write off specific customer accounts yet, we record the estimated reduction in accounts receivable in a new contra asset account called the allowance for doubtful accounts. Now let's see how the allowance works. As an overview, the allowance method uses a two-step process to handle bad debts. First, the company estimates how much of its accounts receivable will be bad. It bases its estimate on past collection history and current economic information. Remember that when we make this estimate, we don't know specifically who will not pay us. If we knew who would not pay us, we would never have sold to them on credit in the first place, right? At the end of every accounting period, then, the company records an adjusting journal entry for estimated bad debts. Bad debt expense is debited, and the credit entry is made to the allowance for doubtful accounts, which reduces accounts receivable on the balance sheet. As I mentioned before, the allowance is a contra asset account, which means it has a normal credit balance. It is this first entry that matches bad debt expense with sales revenue and also reduces net accounts receivable to the amount that is expected to be received in cash. Second, when the company determines that a customer is never going to pay the amount owed on account, the company writes off the receivable. The allowance account is debited for the amount of the bad debt and accounts receivable is credited. Notice that the second entry has no impact on net assets or on net income in the income statement. Let's look at an example next with real numbers. In this example, at the end of the period, assume the total balance in accounts receivable is $278,000. And Barton estimates that 3,000 of these accounts receivable will not be collected. The adjusting entry requires a debit to bad debt expense and a credit to our new account, the allowance for doubtful accounts, for the estimated amount. Why can't we just credit accounts receivable in this entry? Again, remember, we are recording an estimate of uncollectible accounts, and we don't know who specifically will not pay us. If we tried to credit accounts receivable, which customer subsidiary account would we use? The answer is we would not know which one to use. As a result, we credit the allowance for doubtful accounts. Works pretty nicely, don't you think? As a reminder, the allowance for doubtful accounts is a contra asset account. It has a normal credit balance. It's reported on the balance sheet as a subtraction from the accounts receivable balance to arrive at the amount of accounts receivable we think we're actually going to collect. Assuming no beginning balance after posting this entry, the allowance for doubtful accounts would have a $3,000 credit balance. And now for the grand finale. On the balance sheet, the allowance for doubtful accounts is subtracted from the accounts receivable balance. The reported value of $275,000, is called the net realizable value. It is the amount of accounts receivable that we actually think we will collect in cash, and it is reported to our financial statement users on the balance sheet. Are you just so excited to know how we might estimate the amount of bad debts? How did Barton Company in our example come up with the $3,000 as their estimate? I'll leave you with that very exciting thought. Stay tuned. We'll find out the answer in the next video.